If you want to understand what's really happening in the silver market, stop watching the daily price chart. Start paying attention to when prices move, not just how much they move. Because what just happened didn't occur during a busy trading day with headlines flashing and commentators talking over each other. It happened quietly, after hours, when most people weren't watching at all. And that's the part almost everyone is missing. This wasn't a slow grind higher. It wasn't a normal breakout. It wasn't investors warming up to silver. What we saw was a sudden, violent price move in a market that's supposed to be deep, liquid, and stable. And it happened when liquidity was thin. That should make you pause. Not because it means silver is going to the moon, not because you should rush out and buy anything, but because moves like this don't come from emotion. They come from urgency. Somewhere in the system, someone needed exposure immediately, and they were willing to pay up to get it. No patience. No waiting for better prices. Just action. And when that kind of urgency shows up off hours, it's rarely random. I'm not here to hype you. I'm here to help you see what most people aren't even looking at yet. Because this isn't about silver prices. It's about how the system behaves when pressure starts to build. Most people are trained to look at markets the wrong way. They're taught to focus on headlines, daily candles, and surface-level explanations. Prices go up? Must be optimism. Prices go down? Fear. Everything gets reduced to emotion, sentiment, or investor mood. That framework works until it doesn't. Because what we're dealing with here isn't a mood swing. It's not a news reaction, and it's definitely not retail traders suddenly waking up on a Sunday night and deciding to pile into silver. The mainstream narrative treats silver like just another commodity, an industrial input, something abundant, boring, and interchangeable. If demand rises, supply will catch up. If prices spike, the market will smooth it out. End of story. But that narrative only works if the system underneath is healthy. What most commentary ignores is market structure, how pricing is actually formed, who provides liquidity, and what happens when that liquidity quietly disappears. Futures markets don't just reflect supply and demand, they rely on confidence. Confidence that sellers will show up, confidence that contracts can be rolled, confidence that delivery obligations won't be stressed. When people say it's just futures trading, what they really mean is, I assume the plumbing works, but plumbing failures don't announce themselves politely. They show up as pressure, as gaps, as sudden moves at inconvenient times. And here's the key reframe. The most important signals don't come when everyone is watching. They come when participation is thin, when the system has less ability to hide imbalance. That's why off-hours moves matter. Not because they're dramatic, but because they're revealing. They show you where assumptions stop holding. And once assumptions break, prices don't adjust smoothly. They adjust abruptly. Let's strip this down to verifiable facts and observable data. First, the price action itself. During the overnight electronic session, silver futures experienced a sharp upward move shortly after the market reopened. This occurred outside normal U.S. trading hours. Second, inventory data. Public reports on U.S. futures exchange silver inventories show that registered inventories, metals specifically designated as available for delivery against futures contracts, have declined significantly over the past several years. While total inventories fluctuate, the registered category has remained near multi-year lows, even as open interest in silver futures has stayed elevated. That means a relatively small pool of deliverable metal is backing a large number of paper claims. Third, physical market pricing. Retail premiums on physical silver products, such as coins and small bars, have remained persistently above historical norms. In many cases, U.S. buyers have been paying several dollars over the quoted spot price. Elevated premiums have lasted far longer than what would normally be expected during short-term demand spikes, suggesting ongoing supply tightness rather than a temporary surge. Fourth, industrial demand trends. Silver is a critical input for photovoltaic solar panels, electronics, medical applications, and certain defense technologies. According to industry reports, global solar installations have increased sharply over the past few years, and silver usage per panel has declined more slowly than expected. At the same time, mine supply growth has been modest, constrained by declining ore grades, permitting challenges, and long project lead times. Fifth, the supply balance. Industry data indicates that annual silver demand has exceeded combined mine production and recycling in recent years, creating a recurring supply deficit. These deficits are covered by drawing down existing above-ground inventories. Once drawn, those inventories are not quickly replaced. Finally, market positioning. Regulatory reports tracking futures positions show that a relatively small number of large commercial entities hold a significant share of short positions in silver. This concentration has been stable for years and is publicly documented. While such positions are often described as hedges, their size and persistence are notable. Individually, none of these facts guarantee higher prices. Together, they describe a market with tight physical availability, heavy paper participation, and growing sensitivity to disruptions, especially during periods of reduced liquidity. That context matters when interpreting sudden, off-hours price movements. When you step back and look at these facts together, a few strategic interpretations start to emerge. None of them require conspiracy thinking. They simply require understanding how complex systems behave under stress. One possible interpretation is that the silver market is becoming increasingly fragile. Not broken, fragile. A fragile system functions normally most of the time, but reacts disproportionately when pressure is applied. Small disturbances can produce outsized reactions, especially when buffers are thin. Another interpretation is that pricing power may be slowly shifting away from speculative traders and toward users with non-negotiable needs. Industrial consumers don't buy silver because they think it's undervalued. They buy it because their production processes depend on it. When supply becomes uncertain, their behavior changes. They prioritize certainty over price, which can show up as sudden, aggressive buying rather than gradual accumulation. This could also suggest a growing disconnect between risk models and physical reality. Many large market participants rely on historical volatility, liquidity assumptions, and the expectation that positions can always be rolled forward or hedged. Those models work best in stable environments. When inventories tighten and delivery risk increases, models tend to lag reality. There is also the question of incentives. Large institutions that provide liquidity during normal hours are compensated for smoothing price action. But during thin sessions, incentives change. Fewer participants are willing to stand in front of aggressive orders. That doesn't mean manipulation disappears. It means the system has fewer shock absorbers. From a strategic perspective, this environment favors participants who are patient, well-capitalized, and less dependent on leverage. It disfavors those who rely on tight spreads, constant liquidity, and predictable roll mechanics. It's also worth considering how power responds to stress. Historically, when commodity markets show signs of instability, responses tend to fall into predictable categories. Regulatory adjustments, margin changes, messaging designed to calm speculation, or efforts to increase perceived supply. These responses don't always resolve underlying shortages. They often delay recognition. None of this guarantees a straight line higher. Volatility can cut both ways. Sharp moves can reverse. But strategically, markets exhibiting these characteristics tend to experience more frequent dislocations, not fewer. In other words, what we may be seeing is not a single event, but a change in behavior. And behavior changes usually precede narrative changes, not the other way around. When stress shows up in a market like silver, it rarely stays contained. That's because silver sits at the intersection of several larger systems: financial, industrial, and geopolitical. From a market perspective, repeated dislocations signal that price discovery is becoming less reliable. Futures markets are designed to aggregate information smoothly. When they stop doing that, when prices jump instead of adjust, it suggests that assumptions about liquidity and supply availability are weakening. That doesn't just affect silver. It affects how participants think about other commodities priced the same way. For banks and large financial institutions, this kind of environment introduces balance sheet risk. Volatility increases margin requirements. Thin liquidity makes hedging more expensive, and concentrated positions become harder to manage without moving the market. Even if losses are avoided, capital efficiency declines, which matters in a system already dealing with tighter credit conditions. At the currency level, commodities under stress often act as pressure indicators. Persistent deficits in real assets tend to expose the limits of fiat-based pricing systems. When confidence in abundance erodes, markets start to reassess what stable value actually means. That reassessment doesn't happen overnight, but it compounds over time. For governments, the implications are increasingly strategic. Silver is no longer just a metal for jewelry or coins. It's embedded in energy policy, defense planning, infrastructure spending, and technological competition. When access to critical materials becomes uncertain, governments respond by prioritizing domestic supply, stockpiling, or reshaping trade relationships. Those responses can tighten global supply even further. On a global level, this feeds into a broader pattern: fragmentation. Supply chains that were once optimized for efficiency are being rebuilt for resilience. That shift is inflationary by nature. It increases costs, reduces flexibility, and makes sudden shortages more impactful. The key point is this: market stress in silver isn't isolated noise. It's part of a wider transition away from a world built on excess capacity and easy assumptions. As that transition unfolds, systems don't fail all at once. They strain, adapt, and occasionally snap, then reset at a higher cost. And those costs don't stay in financial markets, they move outward. It's easy to hear all of this and think, interesting, but abstract. Futures markets, inventories, geopolitics, none of that feels connected to everyday life. But this is where the macro story becomes personal. When markets struggle to price essential materials accurately, costs don't disappear. They move downstream. They show up slowly, then all at once, in places people don't immediately connect to metals or commodities. Start with cost of living. Silver is embedded in electronics, energy systems, medical devices, and transportation infrastructure. When supply tightens or prices become unstable, manufacturers don't absorb that indefinitely. Higher input costs get passed on. Then there's jobs and wages. Industries rely on stable pricing. When volatility increases, companies delay projects, cut margins, or relocate. That uncertainty affects hiring decisions, capital spending, and long-term wage growth, especially in manufacturing-heavy regions. Now, consider savings and investments. Most people assume markets will remain orderly, that assets can always be sold when needed. But periods of instability tend to expose which assets are liquid in theory versus liquid in practice. Understanding that distinction is key. There's also a psychological effect. When prices behave erratically, people feel less confident. Spending slows, precautionary savings increase. Finally, think about family planning and long-term security. Rising volatility creates persistent pressure on budgets and planning. The point isn't fear, it's awareness. When you understand macro stress, you stop reacting emotionally, and you start making decisions based on resilience instead of hope. To make sense of environments like this, you need more than opinions or predictions. You need a way of seeing. I call this approach the structural lens. The structural lens doesn't ask, is the price going up or down? It asks, what assumptions does this system depend on? And are they still valid? Every market rests on invisible agreements about liquidity, about delivery, about trust, about who will show up when pressure appears. Most of the time, those agreements hold, so nobody thinks about them. The structural lens focuses on moments when they don't. Instead of tracking headlines, it tracks stress points. Instead of reacting to price, it observes behavior. When markets move violently during quiet hours, that's a signal. When physical premiums stay high despite falling paper prices, that's a signal. When inventories decline while paper claims remain elevated, that's a signal. Individually, these signals can be dismissed. Together, they form a pattern. This framework also separates volatility from instability. Volatility is movement. Instability is when movement reveals fragility. A stable system can be volatile and still function. A fragile system becomes unstable under relatively small shocks. Most people don't get hurt by being wrong about direction. They get hurt by being wrong about structure. The structural lens helps you avoid that mistake. It doesn't tell you what to buy or sell. It helps you decide what assumptions you're willing to trust and which ones deserve skepticism. Once you adopt that mindset, you stop chasing certainty. You start managing exposure. And that shift, more than any prediction, is what protects you over time. Third, prioritize flexibility over prediction. You don't need to know what silver will do next week. You need to know how you would respond if volatility increased, if correlations broke down, or if access to certain markets became temporarily restricted. Fourth, watch incentives, not narratives. Governments, banks, and large institutions respond to pressure in predictable ways. They protect stability first, not individual participants. Understanding that helps you interpret policy changes, margin adjustments, and regulatory responses without panic. Fifth, stay grounded in time horizons. Structural changes play out over years, not days. Short-term reversals don't invalidate long-term pressures, just as long-term trends don't eliminate short-term risk. Confusing the two leads to emotional decisions. Finally, keep learning from behavior, not forecasts. Markets tell the truth through action long before they admit it through words. When behavior changes, assumptions deserve review. Preparation isn't about fear, it's about optionality. When you build optionality into your thinking, you don't need certainty, you just need awareness, and awareness compounds. What you witnessed wasn't a prediction, and it wasn't a warning siren. It was a glimpse into how systems behave when pressure starts to surface. Nothing here requires panic. Markets will continue to move. Prices will rise and fall. Headlines will come and go. Most days will look ordinary. But once you've seen stress for what it is, you don't unsee it. You start noticing when movements feel forced instead of organic, when price action reflects urgency instead of speculation, when confidence quietly gives way to contingency planning. That awareness changes how you listen to narratives. It changes how you interpret volatility. And it changes how you make decisions, not by reacting faster, but by reacting less. The goal was never to tell you what to do. The goal was to help you see what matters. Because in uncertain environments, clarity is the real edge. Not leverage, not speed, not conviction, just understanding. And once you have that, you don't need to be early. You just need to be prepared.